Professor Robert Webb. I think most people know him as the chief editor of a Journal of Futures Market, right? And then some more information on his background. Professor Webb received his MBA and PhD both in finance at the University of Chicago. Before joining the University of Virginia, he was a consultant to the World Bank, and as told me earlier, also was the chief economist in the Chicago Merchant Exchange, responsible for designing the future product, some of the future product. And then he himself became a trader for the product he designed. Am I right?
That's correct.
For 3 years' time. Is that totally legal? Okay. He also served as the senior financial economist at both the executive office of the President Office of Management and Budget and the Commodity Futures Trading Commission. And Professor Webb was also heavily involved in academics. His research interests include the derivative security and markets, trading and the behavior of speculative prices and market microstructure. He's the editor of the Journal of Futures Market mentioned earlier, and he has published at least 3 books. The Macroeconomics, Information and the Financial Trading, Trading Catalysts, How Events Bull Market and Create Trading Opportunities and Stock Market. And Stock Market Trading Lesson for Volatile Times. And today he's going to talk about this yesterday's, tomorrow, past vision of future financial market. With that, he's going to share with us his knowledge and experience in the market for the past 2 or 3 decades.
Okay.
Please.
Good afternoon. It's my pleasure to be here this afternoon to talk about a topic that I think, or at least I hope you'll find of interest. Basically, all of us have at some point or other kind of thought about the future and have come to see that the future has not quite turned out as we thought it might be when we first thought about it. And so that, I guess the way I like to think about it is that when we think about, the future, and we can think about that as, the tomorrow, it is always very easy to imagine that the present, yesterday's tomorrow, was always the future that was expected in the past. And I'm going to give a variety of examples that show that's not the case. Okay, in fact, that our future oftentimes differs from what we thought we would find. But yet, what we now accept as a normal state of affairs is that the present was not the only possible outcome that could have come to pass, nor oftentimes it was the most commonly expected one. What we oftentimes consider as an inevitable, when viewed from the vantage point of hindsight, was often not immediately embraced or accepted. Now, so I'm a firm believer that if we want to understand where we are going, we really do need to have a good understanding of where we were and how we got there. And so I want to focus on financial markets in general, but I want to focus on our past visions of derivative markets in particular. And I think that there are a variety of lessons that we can kind of glean from looking at what has happened in the not so distant past from my perspective. But from many of you, I see a lot of young faces in the audience, a fairly distant past. Okay? And so there are very few advantages of age, but one of them happens to be that you get to have kind of live through a variety of different experiences. And you have the knowledge of the context in which a variety of events occurred that is sometimes distorted when we think about the past or when we learn about past events. Because when we do look at the past, it's oftentimes distorted because history, it's been said, is written by the victors, and the same thing is true in terms of financial history. And so we end up with kind of a distorted view in terms of what actually happened. Now, as was stated at the introduction, I've actually been very fortunate in my life to really have had a kind of a catbird seat to witness a lot of these changes, starting as a student, extending to being a researcher on the topic, to having worked at the U.S. Commodity Futures Trading Commission, which regulates futures markets in the USA, and the Executive Office of the President, Office of Management Budget during the Reagan administration, as well as working at the Chicago Mercantile Exchange, first designing futures and option contracts as senior financial economist, and then trading on the floor of the Chicago market, then later trading at the World Bank's investment department. Okay, so I want to start off with a variety of comments about the world that you know today, and I do want to kind of pay tribute to the fact that most of you are really relatively young, and so from your perspective, you've always lived in a world where exchange-traded derivatives on financial assets have existed. And many of you have also always lived in a world where interest rate swaps and other over-the-counter derivatives were important. And I would say that most of you have also always lived in a world where exchange-traded derivatives on energy, in general, and crude oil in particular, existed and were important. And most of you have also always lived in a world where large Asian financial and commodity markets existed and were important in the global price discovery process. But here's the key point. This was not always the case. And we don't have to go very far back in time for all of these statements to see that we did have a very different world not too many decades ago. Now, I want to start off by kind of recognizing a variety of kind of anniversaries, and this talk today, I should add, is actually based on a article I wrote that was published last year in Applied Finance Letters. And so that if we look at 1972 from a financial perspective, one of the key things that stands out about it was a very important year in terms of financial innovations. And the financial innovation that was key in that year was the creation of the first successful financial futures contracts. Those were created at the Chicago Mercantile Exchange. In the international monetary market, they were contracts on a variety of foreign currencies: the Swiss franc, the French franc, the German mark, the British pound sterling, the Canadian dollar, were all currencies that financial futures were introduced on. And this kind of idea, if you will, started off because people wanted to speculate, and they weren't really kind of able to do so easily. And so Leo Malamed, who played a very key role, and still does to some extent at the Chicago Mercantile Exchange, and is often considered the father of financial futures, contracted with Milton Friedman, then a professor at the University of Chicago, to conduct a consulting study to see whether or not futures contracts on foreign currencies were feasible. The study was done by Professor Friedman. The answer was yes, that they were. The international monetary market was created, and it became successful. But in fairness, I should add that before the Merc was successful with the introduction of foreign currency futures, there had been an attempt to do exactly that in New York at another exchange, the International Commercial Exchange, not to be confused with the Intercontinental exchange that exists today, that's based in Atlanta. And those contracts were introduced in 1970, and they failed. But the reason for the success of these financial futures was that the Bretton Woods Agreement had collapsed. we no longer lived in a world of fixed exchange rates. Yeah, we lived in a world where there was going to be volatility in exchange rates. So timing really was very, very critical to the success of these contracts. And one other point I should mention at the outset that it may seem that these contracts were kind of created with the idea that people thought they would be tremendously successful. Actually, the fear was that they would not be. The international monetary market was established as a separate entity because if these contracts weren't successful and they failed, it would not affect the Chicago Mercantile Exchange. Later, the IMM became a division of the CME. But initially, it was created as a separate entity. And the idea behind financial futures is the biggest commodity around is money. Okay. Now, 1973, only 42 years ago, exchange-traded equity options were introduced in the USA at the Chicago Board Options Exchange. Ever wonder why it's called the Chicago Board Options Exchange? Well, there's another exchange that used to exist as a separate entity called the Chicago Board of Trade. The Chicago Board of Trade created the Chicago Board Options Exchange. Again, they created it as a separate entity because they did not want to be regulated by the SEC. Now, the SEC actually was a very reluctant regulator. It didn't really believe, in exchange-traded equity options. But the USDA, which regulated commodity markets at that time, did not want to have anything to do with regulating equity options. Hence, that's why the Board of Trade created this separate entity called CBOE. They spun it off and and the members of the Chicago Board of Trade also then own that exchange. Now, on opening day, which was in April of 1973, 911 contracts were traded, each for 100 shares. They were all call options, okay? And they were call options on 16 listed stocks. Now, again, it's hard to imagine a world where you have a financial capital and you don't have, an active exchange-traded equity options marketplace. But again, it's only 42 years ago that we had exchange-traded equity options really for the first time. So if we think in terms of answering this kind of recurring question, and I won't phrase it on every slide, but I've phrased it on this one, what did the future look like in the past? Okay? And what did it look like for exchange-traded equity options? Well, there are a number of worries. Now, I was a student at the time, and one of the publications I read with some regularity was Business Week. It was called Business Week at that time, not Bloomberg Business Week, as it is today. And one of the concerns was, that people would like to trade options more than they would stocks. And all the trading activity, all the speculative activity would be in the options market, and stocks would be moribund. Stock prices wouldn't move, but there would be all this option trading. Now, that idea, that worry was really kind of ill-founded and kind of represented a total misunderstanding of the nature of options because you wouldn't have an active options market if the underlying securities are inactive. But nonetheless, that was one of the concerns. Another concern really was put options. Now, 1973 and 1974 actually represented a major sell-off in U.S. equities, with U.S. equity prices down around 40% in nominal terms, and it was a somewhat inflationary environment, and then of course larger in terms of real terms. And so the SEC prohibited trading in put options. Now, I imagine that virtually everyone is familiar with the concept of put-call parity. Yeah? Think about it. Now, how easy is it to achieve put-call parity if you can't trade put options? Okay? And who prohibited it? The regulator. Okay? So understanding financial markets is not necessarily, or I should put it differently, the presumption that regulators fully understand financial markets isn't always true. Sometimes regulators can be an impediment to a fully functioning market because of misunderstandings that they have, or at least policies that the heads of those organizations have adopted. So it was 4 years before trading in put options was actually approved. Now, it's important also to kind of note that in one sense, there's nothing new under the sun. When we think in terms of financial innovations, we start with a world where there are kind of 4 basic securities, right? We have the pure discount bond, our zero coupon bond, we have equities, and we have option contracts, and we have forward contracts. And from those 4 basic securities, we create all sorts of other types of securities, and hence financial innovations. And so in the past, there are a variety of kind of options on exchange-traded products, and that included options on futures. In the United States, these are called privileges, and these options might have very short maturities, let's say a day or something of that nature. And so trading in privileges, at one time was banned in the U.S., and then we did not see a resumption of trading in options on futures until the 1980s in the USA when they were reallowed. Now, from an academic perspective, 1973 is a very interesting year as well. And so, as was mentioned, I had the good fortune of going to the University of Chicago for my MBA and PhD degrees. I started in 1974, and my professors included Gene Fama, Myron Scholes, and Fisher Black was there as well, so he was also a professor of mine during the first year before he then left for MIT because his wife hated living in Chicago. But in any event, the seminal paper by Fisher Black and Myron Scholes on option pricing is something that has had a profound impact on the academic literature and academic research, and it's rightly credited with stimulating a lot of academic research, and to some extent igniting the subsequent explosion in derivative securities as well. Now, keep in mind, though, that the Chicago Board Options Exchange didn't wait until this paper came out before it was established. Okay. So there's a little serendipity in terms of the creation of the SIBO as well as the publication of this paper. Now, this article, which has had a profound impact on the financial economic literature, was a paper that was very difficult to sell to journal editors. It was actually kind of an editor's nightmare because this is happens to be an article that was rejected at virtually every place that it was sent. Okay? The one place that was finally accepted was a University of Chicago publication, the Journal of Political Economy, and that was with some kind of pressure from kind of the business school faculty. Okay? And which goes to show that editors are sometimes wrong as well. Okay, now. I'll quickly add that not every paper that editors reject is going to be another path-breaking piece of research, but nonetheless, we make mistakes as well. Now, thinking in terms of kind of the background again of Fisher Black, and a kind of very interesting individual, had his PhD in applied mathematics from Harvard University. Yeah, and of course, I would imagine everyone's familiar with the article, and they utilize stochastic calculus and Edel's lemma. But the important point sometimes is lost. At least I've seen, in terms of students that I've taught over the years, and that is that it's easy to emphasize kind of the mathematical side of it, but the fundamental breakthrough that Fisher Black and Myron Scholes had was financial, not mathematical. Okay, the insight that they had that led to this, option pricing model was financial, not mathematical, and it was a simple idea. A simple idea that if you're able to perfectly hedge a security position, the expected return of that perfectly hedged position is a risk-free rate. That's what led to the breakthrough. Okay. Now, how do we know that that's the case? Well, another way of kind of, I guess, raising this is kind of ask the question: does anyone know who James Boness is? Okay, not everybody at once. Okay, I mean the typical response is that nobody knows who he is. Or I should say who he was, because he died a few years back. And James Boness got his PhD from the University of Chicago, in the 1960s. And was a professor at the State University of New York at Buffalo for many, many years. He was one of many researchers working on option pricing. And I think it's important to understand that in academia, like in other fields, that there's this competition, okay? And there's this competition to be first, because, being second isn't really close enough, okay? In terms of intellectual priority. Now, James Boness is someone who came very, very close, to the option pricing formula that we call the Black-Scholes option pricing model. He was just kind of one variable away from it, okay? And again, he was close, but not close enough. So the consequence is that he's unknown, and and we think of Fisher Black and Myron Scholes. But there's a couple other important points. First, I'm not trying to denigrate the tremendous achievement of Fisher Black and Myron Scholes. They were in the case of Fisher Black, and a tremendous scholar, and the same is true for Myron Scholes. He is a tremendous scholar. But when we think in terms of contributions, in almost every area of science, the contributions that people are making are built on on those who've kind of gone before. And so it's easy to kind of get the erroneous impression that there's a little idea that kind of drifted down one day, and Fisher Black and Myron Scholes popped out this option pricing model. But there are a variety of other people working on the same problem, like Paul Samuelson and Bob Merton, who came close, but not close enough. And James Boness was somebody who came close as well. Okay. Now, it's also kind of easy from an academic perspective to get a little bit conceited in terms of the influence of academia and academic research on the world of practice. To be sure, Fisher Black and Myron Scholes' article played a crucial role in kind of stimulating not only academic research, but also some of the developments on the practical side of finance as well, in terms of creating new derivative products. But in kind of keeping with this book that was written a number of years back called The Wisdom of Crowds, it really is kind of testament to the power of the wisdom of crowds, that later studies have shown that when we look at some option markets that did exist on commodities, etc., that the prices that were determined in those markets actually came very close to Black-Scholes option pricing model prices. Not that the Black-Scholes option pricing model has to be, quote, the correct or true price. But the point I want to make is that, if you're a trader on the floor of any exchange, or if you're a trader off the floor of any exchange, the interaction that you have with other traders is going to end up in kind of producing prices that kind of make sense. Because the penalty for making prices that don't make sense is that you go out of business. You lose all your money. And people don't care about taking your money. They're happy to do so. Okay? And so we shouldn't be really too surprised, that the marketplace works. Okay? And even though no one understood Black-Scholes option pricing at the time because it wasn't, quote, created, you ended up with prices that were consistent with Black-Scholes models. Yeah.
Rob, I am aware of another paper.
Okay.
Published before 2006. I think it's in the 90s. Written by a classmate of mine, talking about the option price in the U.S. I think it's in the late 19th century. They reached the same conclusion. The prices then is very close to Black-Scholes price. I can give you the paper.
Yeah, no, I love to see it. I mean, it certainly is yet kind of another example, that markets work. And again, this isn't meant to kind of denigrate the work of Black-Scholes, but just as a kind of serve as a useful reminder, that again, the markets have to solve the same problem. And oftentimes they end up solving it. Yes, yeah.
So you said that privileges were banned in the US during the 80s. Could you tell me what was the motivation behind developing options model during that time? Because this model was published in 1973.
Right.
So what was the motivation behind that?
Well, in the 1950s, as the story goes, Paul Samuelson, in a visit to Paris, came across Louis Bachelet's dissertation, and that kind of started to stimulate some kind of research in terms of option pricing, and so my understanding is that it was kind of academic curiosity that kind of encouraged a lot of that research. And so again, this French PhD student in his dissertation, he kind of made some important contributions, and as you're probably aware too, he came across this notion of Brownian motion before Albert Einstein did, and really was kind of applying it to changes in speculative prices, and in this case, changes in prices on the Paris bourse. Yeah. Okay, so now one other kind of notion that I think is kind of widespread, but erroneous, is kind of the idea that once you have let's say, a new product that is successful, that it was initially successful, that it was immediately embraced, and that everyone should have recognized, that it would be immediately successful. But that's not always the case. Sometimes other events, are actually more important. Let me give some examples. So the Treasury bond futures contract, which at one time was the most heavily traded interest rate futures contract, no longer Eurodollar futures are by far. Yeah. But in terms of kind of the term structure of interest rates at one time, this contract was the dominant one, and then 10-year Treasury note futures were introduced later, and they became more heavily traded. But when the Chicago Board of Trade introduced Treasury bond futures contracts back in 1977, the trading was actually relatively slow. Okay, and by 1979, they were trading something like 4,000 cars or contracts a day. Just a little bit of jargon, because early futures contracts in the USA were on grain, and they had a size of 5,000 bushels, and 5,000 bushels is what would fill a railroad car. We call, a futures contract a car after a railroad car. So we kind of use cars and contracts interchangeably. And so by 1979, the Treasury bond futures contract were trading something like 4,000 contracts a day. But what made these contracts, or this contract rather, successful, was the Federal Reserve. Okay. On Saturday, October 6th, I believe, 1979, there was a special meeting. Paul Volcker, who was then chairman of the Federal Reserve, in his fight against what was perceived as high rates of inflation, decided to switch from targeting interest rates to targeting the quantity of money. Okay, and this caused tremendous uncertainty in financial markets. And by the spring of the next year, March of 1980, you had a credit crunch, and over the next year or so, in the United States of America, Treasury bill rates were 20+%, 22%. Over the next couple of years, the long-term interest rate, the 30-year Treasury bond rate, was 16%. But this attempt to fight inflation by switching, the target of monetary policy, had as an unintended side effect, a stimulus to using financial futures to hedge yourself. Okay? Now, to hedge yourself against interest rate risk exposure. And it worked because, the penalty for not doing so was, in many cases, losses. Now, here's something else that I think is important. When I worked at the Chicago Mercantile Exchange, designing futures and option contracts, the CFTC required us as an exchange to satisfy this economic purpose doctrine. What that meant, simply stated, was that in order to approve a new contract, the contract had to satisfy economic purpose, and speculation was not considered a legitimate economic purpose. Hedging was. So when we would create a new contract, we would then kind of make the rounds of potential users of these contracts and try to get them to sign off that they would actually use these contracts, and that they would write a letter in support of these contracts to the Commodity Futures Trading Commission. Now, you might think that when you would make the rounds, that you would have a lot of institutions saying, yes, we'll use these contracts. In fact, the opposite was true. I can't tell you how many times you would come across people who would say, oh, we don't have to hedge. Okay? Basically, we know what's going to happen. I mean, and obviously, if they really knew what was going to happen, they should be traders as opposed to doing whatever they happen to be doing. And I would say that it reflects kind of a basic element of human nature. If you're confronted with a choice of learning something complex or not, people will reject learning something complex. reflects a certain kind of laziness that's common across people. And so the desire to use financial futures for hedging came about because, as I said a moment ago, the penalty for not doing so were substantial losses that could be avoided. And more important to individuals deciding whether to use them was the potential for losing their own job. Okay, so if we think in terms of other financial innovations, it's been 34 years since interest rate swaps were created. And the first interest rate swap occurred between IBM and the World Bank. Okay, no financial intermediary, just these two organizations kind of getting together. Now this market, it took off very quickly. And if you look at the interest rate swap market, basically you can kind of divide it into kind of two markets. One is a retail market, if you will, the interest rate swap market. And then there's a parallel market, kind of the synthetic interest rate swap market, which you can create, by using Eurodollar futures, piecing together Eurodollar futures, to create synthetic interest rate swaps. And so, banks became kind of dealers in interest rate swaps, and they would have interest rate risk exposure after kind of netting out their positions, and they could hedge themselves in the Eurodollar futures market. And if you think in terms of Eurodollar, if you think in terms of most futures markets, with the exception of Japanese markets, most of the trading tends to be concentrated in the front month contract. Okay. The success of interest rate swaps actually caused Eurodollar futures to be kind of pushed out for 10 years. Now, again, most of the trading occurs not in the front month contract, but maybe the second or third contract out there. But you have kind of this fairly active trading in deferred contracts. So again, even though the future is more uncertain, even though the more distant future is more uncertain than the near future, we still observe, in most markets, more trading in near future contracts and in distant future contracts. Now, Chicago dominated trading in financial futures and would have dominated trading in U.S. Equity options as well. Had it not been for a decision by the SEC, which I said was a reluctant regulator for exchange-traded equity options, a decision by the SEC to divvy up these right to list equity options among various options exchanges. And so, in effect, the regulator decided it wanted to have more than one exchange to regulate, and arbitrarily kind of allocated the stocks to be listed for equity options. Now, we live in a world today where the trading in the Asia-Pacific area for financial futures exceeds that in North America and exceeds that in Europe. But when financial futures were first introduced, Chicago dominated it, and that kind of did a couple of things. It stimulated the development of markets in other places, which we'll talk about, but it also caused the two major futures markets to kind of think about how they would deal with the potential demand from abroad, outside the U.S. And the Chicago Board of Trade took one approach, which was to create evening sessions for some of its more popular contracts, to try to capture that business from really during the Asian time zone. And the Chicago Mercantile Exchange took a different approach. That was to create linkages with other markets. And the first linkage it created was actually with CIMEX, which no longer exists as a standalone exchange, CIMEX standing for Singapore International Monetary Exchange, and now is part of the Singapore Exchange, SGX. Yeah, but the link it created was one of mutual offset, which allowed someone to initiate a Eurodollar futures position in Singapore and offset it in Chicago, or vice versa. And so kind of two different approaches. Now, as market participants outside the U.S. recognized potential for financial futures, you saw the creation of a number of exchanges. And one of the exchanges that was created was an exchange in London, the London International Financial Futures Exchange, which was known by its acronym LIFE. So when it was first established, for 20,000 pounds sterling, I believe, you could buy a seat on LIFE, and they were actively recruiting, traders from the U.S. markets to kind of go over to London, because they were basically copying the U.S. approach. They would create open outcry auction markets in London, and so after a series of mergers with London Traded Options Exchange and London Commodity Exchange, LIFE was the dominant futures market in Europe. And it turned out its most important contract was this German Bund, the German Bund futures. Now I'm going to return to this, to the LIFE exchange, because a few years after it was created, an exchange was created in Germany called Deutsche Terminbörse. And unlike LIFE, which is open outcry, the DTB was entirely electronic from the really from the get-go. But we'll return to that in a moment, because from a chronological perspective, it happens a little bit later. Okay, so it's 32 years since the creation of crude oil futures by the New York Mercantile Exchange. And I feel compelled to give a little bit of history of the New York Merc, because the New York Merc was this exchange which at one time had as its principal contract Maine potato futures. It was the only futures market in the U.S. to ever default. And the default occurred when, at the time, a member of the Forbes 400, J.R. Simplot, defaulted on his potato futures contract position. And so the exchange had to go from trading commodities, agricultural commodities, to trading something new, and it decided to trade energy. And it started off with heating oil futures, moved on to other contracts. And eventually it introduced crude oil futures. Now, when crude oil futures were introduced by the NYMEX, again, the idea was not immediately embraced. There were 7 large oil companies at the time. They were known as the Seven Sisters. And if you read the business press prior to the introduction of crude oil futures, the people at the Seven Sisters thought they would never use these contracts, that these contracts were unnecessary, and they had no intention of using these futures contracts. And again, they were proved wrong. These contracts served a vital purpose and hence became fairly successful. Now, markets, businesses compete, financial firms compete, financial exchanges compete, financial centers compete against each other. And the success that the New York Merc had in transforming itself from this kind of backwater exchange trading Maine potatoes as its main, the state of Maine, potatoes, as its primary contract to trading energy contracts successfully, attracted competition from both the Chicago Board of Trade and the Chicago Mercantile Exchange. My colleague Mike Gorham was at the Chicago Mercantile Exchange designing commodity futures. The Merc spent something like $3 million, kind of developing that contract and some other energy contracts with the intent to take control of energy futures and move them from New York to Chicago. Okay, now both exchanges failed. Okay, both the Merc and the board failed in trying to do so. And I had left the employee of the Merc and was now a member of the Merc trading on my own account. And Leo Malabed, who I referred to earlier as the father of financial futures, would give these pep talks to members of the exchange, trying to convince members to support the contracts early on. Now, think about it. Futures are zero-sum. Derivatives are really zero-sum games if you ignore transaction costs, and negative-sum games if you include transaction costs. And so in a pit environment, if all of us in this room are just kind of trading with each other, the only way that I make money is if somebody in this room loses money. And as a whole, when we leave the room, there will be no money made. But in order to attract outside orders, you need to have trading volume. And so you need this trading among the locals. And if outside orders, which we call public order flow, come in, then you can actually kind of make a market and take that spread and act really as a market maker. So the pit as a whole can be profitable. So one of the things the Merc decided to do was to say, hey, we're going to create this new energy complex. We're going to start off by trading unleaded gasoline, and we're going to trade heating oil as well, and we're going to broadcast it live to a meeting of the American Petroleum Institute in Texas. Well, about 20 of us show up on opening day, and I show up because I want to do my 15 minutes because this market opens up before the S&P futures market, which I was trading at the time. And unlike the movie, like trading places where you have this frenzy of activity, people shouting and yelling when the market opens up, it's stone dead silent. Now, none of us know anything about heating oil or gasoline other than kind of pumping gasoline in our car or something like that. And we didn't know how to price it. But we did know that there were some people who did know how to price it, and those people were at the New York Merc. And so we're waiting until the New York Merc opened up so we could see the opening price before we could determine what our opening price could be, because we did not want to be off the market. These contracts were a tremendous failure. Trading one lot was 21 ticks wide. So a question naturally arises: why did the NYMEX, this kind of formerly backwater exchange, that was just trading potato futures, secede where the Board of Trade and the Chicago Merc, failed in trying to get control? And the answer oftentimes is a first mover advantage. Okay, if you have a liquid market, it's difficult to kind of establish a competing market that can take control of that market. Now, it does happen, and I can give you some examples where control has shifted. But it wasn't from a lack of effort. It wasn't from a lack of resources. Both the Merc and the Board of Trade tried but failed to take control from the NYMEX. Now, 1988, was a year after the stock market crash of October 19th, 1987. I was trading on the trading floor of the World Bank at the time. I was trading bonds. Okay? And so one little known fact of that day is that when the stock market was heading south, so were bond futures. Okay, yet on Tuesday, October 20th, 1987, you had the largest one-day rally ever in U.S. Treasury securities. Okay, yeah, and the next day that came close was actually October 31, 2001, when the U.S. Treasury announced that they were eliminating the 30-year Treasury bond. Yeah, and so we have this Brady Commission report. This report tried to determine kind of the causes of the crash. Index futures were blamed. Portfolio insurance was blamed. Index arbitrage was not the cause of the crash, but what I want to indicate is that we don't really know what the cause of the crash was, and we still don't know. We still don't know. Now, the '87 stock market crash was important from an academic perspective in a couple of different areas. One is that it showed that the pricing of deep, out of the money options, was wrong. It didn't really kind of properly assess kind of tail risk, and it stimulated research in two areas. One was an extreme value theory, and its applications to financial markets. And the other area was actually in terms of behavioral finance. Bob Shiller had kind of, the foresight to kind of do a little bit of kind of research at the time, and kind of polling portfolio managers as well. And so it did kind of question one of the bedrock assumptions of modern finance theory, market efficiency, is whether that was correct. Fast forwarding to 1998, the virtual collapse of long-term capital management was not a derivatives event per se, as I mentioned right here, but it did kind of stimulate a lot of research on liquidity risk. And the reason for mentioning this is that I think that one thing that oftentimes we fail to do as academics is to kind of pay close enough attention to some of the things happening in the world of finance. And so the failure of LTCM, which had people like Myron Scholes and Bob Merton associated with it, and they had just won the Nobel Prize, the previous year, because of their contributions to option pricing. It led people to kind of focus on the causes of that calamity, and liquidity risk started to receive a lot of attention afterwards. However, if you looked 4 years earlier at a company, that David Askin Capital, and David Askin, I remember, he came over to the World Bank when he was at Drexel Burnham Lambert, and I was there to listen to one of his presentations. He had formed this kind of fund, which was basically doing something fairly similar to what LTCM was doing. Okay. And trying to take advantage of kind of mispricings. And when you're trying to take advantage of mispricings in markets where mispricings are small, you have to be highly levered. Otherwise, you just can't do it. So these kind of market neutral kind of strategies require high amounts of leverage. But he lost $640 million in a $600 million portfolio. When he was down $40 million, he asked investors if they wanted to invest more, and of course, not surprisingly, the answer was a resounding no. Okay, so we think today about markets, and the markets are electronic. I teach a class in trading at the University of Virginia. I have done so over the last 21 years. Typically have some kind of exercise where we use kind of a simulated pit environment, open outcry auction. because I think it's actually a good way of learning about and understanding the process of trading. Now, this idea that markets should be electronic, actually is an old idea, okay? And it took, the home of, futures markets a lot longer to kind of adopt electronic trading than what you might think. Now, it wasn't for lack of effort. When I was at the CFTC, the people who founded the Intex, a Bermuda-based exchange, which was going to trade electronically copycat versions of successful financial futures and commodity contracts that were kind of listed in the U.S. Was created 4 years later. The founders of that actually stopped by, gave a presentation to the CFTC because they initially were thinking about starting it in the USA, but kind of regulatory hurdles led them to start in Bermuda. Well, they started in Bermuda in 1984, and it was a dud. It failed. Now, Globex, which I think a lot of you probably would be familiar with, was created by the Chicago Mercantile Exchange, and it was kind of a partnership with other exchanges around the world to kind of, list contracts to trade electronically outside of normal business hours. Okay, that's how it initially started. The only exchange, so when it was first started, it had very low volume. It was a failure. The only exchange of consequence that had significant Globex trading volume was the French exchange, the McIntire, where there was a long history of so-called curb trading, after-hours trading. And so it took a long time, really, for electronic trading to be kind of introduced. And fast forward today, options remain kind of the last area where pit trading kind of remains important. And this is kind of disappearing over time. Okay, at some point in time, this too will change, and we won't see this these markets traded in pits. In fact, the Chicago Mercantile Exchange announced the kind of the end of most open outcry futures trading sometime this year, with a couple of exceptions. Now, I want to get back to this DTB that I talked. DTB that I talked about earlier. Okay, so the Deutsche Terminbörse was this competitor to Life, and it traded on an electronic basis, a variety of German interest rate futures contracts as well as the German equity index. And it was the number 2 exchange. It had about 1/3 of the market in Bund futures to 2/3 in the market in London on the Life. And the funny thing is a lot of the public orders for trading on the Life actually came from German banks. They were routing their orders there. So DTB in 1997 started to convince the German banks to route more of their public order flow to the DTB. And by the autumn 1997, half the trading volume of the Bund futures contract went to the DTB, and Life had the balance. And then Life's share started to fall. And one key kind of point, when you look at an open outcry auction market, typically 30 to 40% of the total trading volume is coming from the locals themselves, the people trading on the floor. And as I said a moment ago, in order for the floor to survive, it needs public order flow. Otherwise, we're picking each other's pockets, okay, and nobody's making any money. So this collapse of Bund futures trading on the Life kind of led to fears around the world where futures were traded. That the days of open outcry were numbered. Okay. It was a death knell for the Life futures market. The McIntire introduced side-by-side trading, and within a month, the pit collapsed. And so the collapse of pit trading on the McIntire it lost market share by life, and to the DTB, sent this shock wave, to open outcry markets around the world. The Sydney Futures Exchange, was quick to kind of phase out open outcry, and by 1999, everything was electronic there. Not so in the USA. And so, it's been 17 years since the DTB merged with Sofx, the Swiss Option and Financial Futures Exchange, to create Eurex. And everybody knew that electronic trading was the future. Everyone knew that pit trading was a thing of the past, and the question was, how long would pit trading last in Chicago? So 12 years ago, the Eurex, had its ambitions to create, an exchange in the U.S. Which would be named Eurex USA. Okay, and the idea was to initially take on the interest rate futures contracts that were being successfully traded on the Chicago Board of Trade, and offer this better electronically traded venue in which to do so. And so everyone knew that Chicago was doomed. Everyone knew that Eurex USA was going to be this complete success, and it would displace the Chicago Board of Trade, and then list, let's say, stock index futures contracts and Eurodollar interest rate futures contracts, and displace the MERC. And so it was 11 years ago that Eurex USA started operations in February 2004. Yet, as I note in the slide, a funny thing happened on this way to kind of world domination, by Eurex USA. In terms of Treasury futures markets, it didn't happen. That 2004 wasn't 1997. The Chicago Board of Trade fought back by lowering prices. Transaction costs are incredibly important. Moreover, the way that this fight was pictured depicted rather in the press was pit traders versus machines, humans versus machines, and that was only partially true, because the Board of Trade also had some electronic trading. And so it really was a mix between Chicago Board of Trade electronic trading and pit trading versus all electronic trading. And once again, you have this kind of choice. If we're going to send in some public, if you're going to send in an order to one of these markets, do you choose the more liquid market in the Chicago Board of Trade, or do you choose this less liquid, all electronic market? Well, the choice is clear. You choose the more liquid market. And Eurex USA was defeated. And so, and we think in terms of some of the other implications of electronic trading. Obviously, if you have electronically traded markets, you don't need these large, very expensive physical trading facilities. Okay? And location is really kind of less important, in one sense. And so the question is, how many of these exchanges do you need? And so there are a variety of kind of transnational mergers, and these were easier in Europe than in some parts of the world, like in Asia. Okay, and the SGX, the Singapore Exchange, tried to acquire the ASX. The two exchanges agreed, but the government of Australia did not agree. Okay, and so we have seen some consolidation within Asia. If you look at the Japanese markets, the government decided that we needed one Japan stock exchange, and the government has forced the kind of the acquisition of Tokyo Grain Exchange by the Tokyo Commodity Exchange, and things like that. But transnational mergers really are somewhat difficult. Now, electronic trading has also kind of changed this kind of need for proximity. Okay, so exchanges derive a fair amount of revenue just from the sale of real-time information, and then now from selling what are known as co-location services. A paper that I wrote with Alex Frino and Vito Malika looked at co-location on the ASX. we were able to look at some kind of unique data. It started in February 2012, and the advantage for which participants would pay at least $10,000 Australian each month to be co-located was 2 milliseconds. Okay, they're paying for a 2 millisecond advantage. Now it takes the human eye between 100 to 140 milliseconds to blink. Okay, and so you're talking about a very short kind of span of time, and lots of participants are paying that much money or more in order to kind of gain that advantage. Now, it's 70 years since Lehman Brothers went bankrupt during the global financial crisis. And derivatives exchanges worked well during the GFC. None of them failed. However, there was a lot of concern about positions in over-the-counter derivatives, especially in terms of credit default swaps, and that led to a variety of calls for changes in the OTC derivatives market, in particular for the creation of trade repositories and for having more clearing as well. And so the credit default swaps, again, one of these financial innovations of the last 30 years, 20 to 30 years, had grown at something like $62 trillion notional market by the time of the global financial crisis. And now the concerns about whether or not these OTC credit default swaps, OTC traded credit default swaps could pose a problem. It turned out to be kind of overblown. They turned out to be less of a problem than imagined, but nonetheless, it led to the meeting of the G20 in Pittsburgh to kind of adopt a variety of proposals that would encourage the central clearing of a lot of these contracts, or require heavier margins. Now, this decision by the G20 is bad news for banks, but kind of good news really for derivatives exchanges. However, you have to distinguish between the future of derivative markets from the future of derivatives exchanges. And at this point, I should actually kind of make a point that I'm in the one city where there's an exception, and that's Hong Kong. By and large, if we think in terms of the value of exchanges, the value is not in terms of stock markets. If you look at the market capitalization in terms of stock markets, the value is low. The one exception, Hong Kong. Okay, but the Hong Kong exchange is the largest exchange in the world in terms of market capitalization this year, with the market value, I guess last month was something like $44 billion US. Last year, though, the Chicago Mercantile Exchange was the largest exchange in the world in terms of market capitalization. By and large, the money nowadays is in derivatives exchanges. That's where the money is. Okay, and that's where the value is. Again, the exception is Hong Kong, with the kind of the tie to China and the sharp rise in the Chinese stock market. And so, if we think in terms of the futures exchanges, and you ask, well, why is there a lot of value in let's say, futures exchanges? Some people would argue it's because they're able to earn an economic rent. And they're able to earn an economic rent because the contracts they trade aren't fungible. And what we mean by fungibility is that if you take a certain grade of corn, you're indifferent between one bushel of that grade of corn and another bushel of that grade of corn, assuming they have the same age, et cetera. And that's not really true for a variety of of financial futures contracts. And the reason why it's not is that the exchanges have their own clearinghouse. Okay? And these clearinghouses are very valuable. ICE bought the New York Board of Trade for this clearinghouse, and it paid $1 billion. Yeah? But another example in terms of the importance of clearinghouse came out. Clearinghouses to futures exchanges came up in 2008. At the time, Hank Paulson, then Secretary of the U.S. Treasury, was kind of spearheading this study of U.S. financial markets, trying to figure out how we can make markets more competitive in the U.S. from a regulatory perspective. And one of the recommendations by the Antitrust Division of the Justice Department was to require that futures exchanges divest themselves of their clearinghouse. Now, there are only 2 futures exchanges of consequence in the U.S. ICE, which has about 10% of the market, and the Chicago Mercantile Exchange, which had acquired the Board of Trade and the NYMEX and a variety of other exchanges, which has not 90% of the market. So it really was a comment about the Chicago Mercantile Exchange. And on February 5th, the reaction to the event or to this announcement was that the Merck's stock price fell about 5.3%, with 1.36 million shares traded. And in contrast, less than 500,000 shares traded, kind of the day before. And then on February 6th, the next day, we had, the stock price fall by almost 17%. And 8.6 million shares changed hands. This is a kind of a demonstration of the importance of a clearinghouse to the value of the exchange. And this is not that the clearinghouse would be eliminated, but it might be eliminated. So this is the expected value, presumably, of what would happen if it, if you assign some probability that would be eliminated. Now, it's been 5 years since the May 6, 2010 flash crash of the U.S. stock market, and that crash ended with a 5-second trading halt, by the Chicago Mercantile Exchange. And that kind of stopped the downward spiral of futures prices during the flash crash. A paper by Matthew Barron at Princeton, Jonathan Brogard at Washington State University, and Andrei Kirilenko, now at MIT, but formerly the chief economist at the CFTC, looked at the immense profitability of high-frequency trading firms. They looked at the month of August 2010 and looked at all the trading in the S&P 500 E-mini futures contract, and they kind of identified the high-frequency trading firms. And the 31 HFTs earned collectively $29 million that month. And the Sharpe ratios that these authors calculated during that month ranged from 3 to 20. Okay, so I hold the Paul Tudor Jones professorship at the University of Virginia. Paul Jones is a member of the Forbes 400 Wealthiest Americans. He's also a very famous discretionary trader. He speaks to my trading class every year, and when he spoke to it 2 years ago, he said that his Sharpe ratio was 1. You may not know Paul Jones, but you probably know Warren Buffett. There was an academic study on Warren Buffett that came out 2 years ago, and Warren Buffett's Sharpe ratio was 0.76. So a Sharpe ratio of 3, let alone a Sharpe ratio of 20, is just out of this world. Okay. But most academic studies, including studies that I've written, suggest that high-frequency trading increases liquidity without increasing volatility. The problem really is in terms of predatory trading. That's the real issue, and we kind of mix up market making with predatory trading, and the good stuff is the market making, the bad stuff is the predatory trading. And so the recent arrest, just a couple weeks ago, of Navander Singh Sarwar in London on the charge of trying to manipulate CME stock index futures prices through layering and spoofing suggests that, if true, U.S. financial markets are actually more fragile than what we think or hope they should be. Yeah. Again, the allegation is not, as sometimes the press is distorted, that he caused the crash, but rather he contributed to the flash crash that day. And spoofing, if you don't know, is really kind of an old tactic that is really trying to mislead or deceive other traders into believing that there's a greater number of buy orders or greater number of sell orders in order to get other traders to act on that belief in order to profit from that. Spoofing is now illegal, but though it exists in electronic markets, it's no different than kind of trying to, I guess, do a head fake in basketball, etc. You're just trying to, deceive other traders. Now, the academic view of what's good for markets is not always what the market adopts. So the simple solution to many of the perceived problems of predatory high-frequency trading actually is to return to a world that we once saw, a world that once existed around the globe in terms of stock exchanges and other exchanges, and that's a world of periodic batch auctions. Okay? Now, there's a lot of academic literature, I've written some myself, that suggests that periodic batch auctions are better in the sense of producing less volatile prices because you're accumulating orders. Okay? However, there's something else that's very important, and that is that you need to always kind of remember, will a proposal pass the market test? Will the market actually want to see it? And Eric Budish at the University of Chicago and a couple of his research colleagues outside of the University of Chicago have written a paper in December of 2013 where they propose introducing periodic batch auctions of a length of 100 milliseconds to 1 second. So that if it were 100 milliseconds in length, we really wouldn't notice it, but it would deter high-frequency traders, and they believe would kind of discourage what they think is an over-investment in technology to be faster, as opposed to competing to produce better prices and lower bid-offer spread. But the point I want to mention is that this idea actually flies in face of history, because we rejected batch auction markets throughout time. The Tokyo Grain Exchange, which I mentioned in passing, was forced to merge with the Tokyo Commodity Exchange, and they had a periodic batch auction market. Tokyo Commodity Exchange does not have that. Steve Wunsch had proposed something, and some of you will be familiar with, the Arizona Stock Exchange a few decades ago. And the idea was that you would have this batch auction process, and that would produce better prices for stocks than a continuous market like the New York Stock Exchange. Now, batch auctions are used at the opening and closing of many markets, but for whatever reason, the market doesn't like them. And so if we think in terms of the futures of derivative markets, that looking ahead, derivatives exist because they are needed, they facilitate price discovery and risk transference. And so long as markets are volatile, the outlook for derivative markets will remain strong. And with that, I'd just like to say I'm happy to answer any questions, and thank you for your kind attention. Yeah.
Is there any geographical advantage in case, say, for the trading in the UK futures? The Cymex, the then Cymex had a first start mover, as you already said, right, over the Osaka Stock Exchange, mm-hmm. And then it keep going. The Cymex has more volume than the Osaka Futures Exchange. Is it true that the geographic advantage is not that much in terms of futures trading is concerned.
So CYMEX had this first mover advantage over the stock futures exchange, even though the home market, the cash market, was in Japan rather than Singapore. The fraction of the total volume did start to decline, but Singapore kind of, I think, continues to, I would say, have around a third. I haven't looked at it recently, but something like a third of that market. It does suggest that geography isn't necessarily important. You don't have to be where the cash market is. Indeed, we can also see that in other markets. If we think in terms of where the consumers are versus where the producers are, and the London Metals Exchange, which of course was recently acquired by the Hong Kong Exchange. So you would have prices of metals being determined in London, even though Britain was not an important consumption market for the metals now, or a market where production was occurring. So you don't have to have the markets located where production occurs. We think in terms of coffee or cocoa and sugar. Those markets are determined elsewhere, principally in New York or London. And so I would argue the same is also true for for index futures. But the key is always going to be kind of public order flow, and one of the problems in Japan is that the Japanese have kind of made themselves their worst enemy, and by making it tougher for individuals to trade futures, and quite honestly, making it tougher for foreigners to trade on Japanese markets.
Do you think it's important to have market makers in derivative markets?
Yeah, that's a great question, and I've kind of changed my mind on that. There's a period in time where I believed it was not that important, because and now I think in some markets it probably is. When we think in terms of the flash crash, for example, it's easy to kind of think about the fact that we have this world where everything is being traded electronically, and then all of a sudden, there's a sharp, drop in prices. In fact, it's not just the stock market. In October of last year, I believe October 15th of last year, we had what the bond market participants consider a flash crash there, where prices suddenly fell in this most liquid of markets, or formerly most liquid of markets, only to kind of come back to where they, or largely come back to where they were moments before. I think it's easy to forget that we've also had in the past, when we did have market makers, periods where we've had unexplained sharp drops. So during the stock market crash of October 19th, 1987, you could try to sell your stock, but the broker might not answer the phone, so the orders never got to the specialist. And when they did get to the specialist would open the stock for trading. If you look at October 19th, 1987, stock index futures were down 29%, even though the cash market was down 23%. Okay? And that reflected the fact that a number of stocks never opened for trading. At the request of the Federal Reserve, the Chicago Mercantile Exchange closed its stock index future trading on the 20th. The Chicago Board of Trade said, "Hell no, we're not going to close ours." They kept theirs open, and the New York Stock Exchange was, quote, open, but a lot of things didn't trade. So even though they had a specialist system in New York, but not one in Chicago. So if you're trading in Chicago, you had no obligation to make a market. Or if you go back to 1962, and I believe it was May 28th, maybe 29th, I've forgotten which of the two, There was something called the Kennedy steel panic. President Kennedy was trying to jawbone steel companies not to raise their prices, and all of a sudden prices fell over 5%, almost 6%, i.e. a flash crash during a specialist-dominated market. Okay? Now, having said all of that, I said at the outset to answer your question that it kind of changed my mind. I do think that having some designated market makers does help in a number of more normal cases of kind of order imbalances. And so in that sense, having these designated market makers would be a good thing.
As you said, the stock market crash of 1987, according to the Federal Reserve report, is down 29% in futures and 20.5% S&P futures S&P spot market. Do you think that in case there's a circuit breaker like that now is in place in the New York Stock Exchange, or time period when you have a certain period of stock call trading, of program trading, that would help prevent the stock market crash in 1987?
Well, short answer is no. And here's my reasoning. We had a circuit breaker. And it was called the weekend. Okay, because on Friday the 16th of October, I was trading at the World Bank and trading fixed income securities, and all of a sudden, the market closes down 4%. It closes down, I think, 108 points. On that Friday, it causes a rally in Treasury bills, and hence I was trading Treasury bills and when issued Treasury bills, and there was a lot of concern. Okay, I went home, being concerned about the market. Thousands of traders did as well, kind of over the weekend. I turned on the news. The top story was on Nancy Reagan's kind of breast cancer, and story number 4 was on the stock market falling 108 points. Monday, when markets opened up, rather than having the weekend to kind of calm jitters, things got worse. And people were more panicked and more worried about what was going to happen. So that's an instance where we had a long trading halt, and it didn't seem to work. Now, in an electronic market, I just gave that example where the Merck closed for 5 seconds, boom, and that kind of ended things. And so I guess I would have to be a little bit more mixed in terms of when circuit breakers work now than maybe I would be a few years back.
Market making depends on the LIBOR rate, right? The current LIBOR rate. So is it not possible to estimate the LIBOR rate depending on the supply-demand principle? Because usually the LIBOR rate is estimated from the historical data that we have.
Well, you raise an interesting question. When I went to work at the Merck, Fred Arditi had just kind of retired as chief economist, and before I arrived, he was the architect of the Eurodollar futures contract. Okay, and so he created this market in which you would survey 7 banks in Britain in terms of what their LIBOR rate was. You would discard the highest one and discard the lowest one and take an average of the other 5. Okay, and it was it was done with the belief that there wouldn't be collusion. Okay? Now, subsequent events have shown that there was collusion, especially during the global financial crisis, and the LIBOR rates that were reported were distorted in order to favor the positions that banks had, and I actually take advantage of people on the other side of Eurodollar futures. So I mean, those are the people who are being harmed, as well as anyone with a contract that was linked to the LIBOR rate. Now, in terms of how easy it is to estimate that, I guess I'll have to kind of pass on, and say that a little bit less certain, because it would seem if it's too easy, that would seem to be a way you should kind of modify contracts and specify it, use that as a specification for determining the LIBOR rate. And if it's too easy, then you don't really need that futures market either.